Tensions between Australia and China have resurfaced, now centering on who controls the Darwin port. The dispute has escalated since the port, which struggled financially for many years, finally began turning a profit. The Australian government has indicated it may move to bring the port back under state control, citing concerns over national interest and security. In late January 2026, Prime Minister Anthony Albanese emphasized during a visit to Darwin that the government is seriously exploring options to regain ownership. Authorities argue that vital infrastructure like this should not remain in foreign hands. Critics, however, question why the issue has only gained urgency now, noting that when the port was unprofitable and a drain on public funds, it attracted little strategic attention. Looking back to 2015 provides context. At that time, the Northern Territory was under financial pressure. The port's facilities were outdated, shipping activity was limited, and operations were running at a loss. With minimal federal assistance available, local officials invited private investment through an open international tender, attracting over 60 global companies. China's Landbridge Group ultimately won, securing a 99-year lease with a bid worth hundreds of millions of Australian dollars, far surpassing expectations. The deal received federal approval, security agencies did not lodge formal objections, and political resistance was minimal. Over the following decade, Landbridge invested heavily, reportedly exceeding $1 billion Australian dollars, to modernize the port. Infrastructure improvements included expanded docks, upgraded shipping channels, and modern cargo handling systems. These efforts significantly increased freight capacity, and by fiscal 2025, the port achieved its first annual profit. Employment in the region rose, trade volumes expanded, and the Northern Territory's budget pressures eased. As the port's long-term investment began to yield results, political sentiment shifted. During the 2025 federal elections, Darwin Port became a prominent talking point, with parties stressing sovereignty and domestic control over critical assets. After securing re-election, Prime Minister Albanese raised the prospect of reclaiming the port, even if that required ending the current lease. Complicating the situation, a 2023 National Security Review reportedly found no definitive evidence that the lease posed a security threat, and no public findings indicated legal or intelligence concerns serious enough to justify cancellation. Still, the discourse around the port grew increasingly tied to international tensions. Beijing responded strongly. China's ambassador to Australia, Xiao Chan, warned that any unilateral cancellation would trigger measures to protect Chinese corporate interests, framing the issue as political rather than merely commercial. Strategic considerations add further complexity. Northern Australia has grown in military significance over the past decade, especially as defence ties between Canberra and Washington deepened. The region now hosts rotational deployments of US Marines, expanded air facilities, and submarine collaboration under the AUKUS program. Darwin's location near crucial sea lanes linking the Indian and Pacific Oceans heightens its strategic importance. While the port functions commercially and has no direct military role, its proximity to expanding defense installations has heightened sensitivities. In today's global landscape, even indirect connections can influence policy. Australia faces a delicate balancing act. China remains the country's largest trading partner, contributing significantly in exports such as iron ore, liquefied natural gas, and agricultural goods, while the United States remains the primary security ally. Navigating strong economic ties with Beijing while aligning strategically with Washington has become increasingly complex, and the debate over Darwin Port reflects the tension between protecting national control over essential infrastructure and ensuring investor confidence and legal stability. Global investors could see this incident as a warning that even long-term agreements are vulnerable when political priorities shift. The stakes extend beyond any single port, touching on the broader challenge nations face in balancing global economic integration with strategic interests. Whatever decision Canberra takes regarding nationalization, it will shape how investors worldwide evaluate stability, reliability, and risk in a climate where business and geopolitics are deeply intertwined. Australian officials understand the gravity of the situation. Behind the headlines, anxiety runs through multiple departments. The Treasury is wary of the message government intervention may send to markets. Trade authorities caution that aggressive measures could spark retaliation, and state leaders fear interruptions to supply chains and export revenues. China remains Australia's primary buyer of key commodities, including iron ore, coal, LNG, barley, and beef, and no alternative market can match this demand quickly. Despite this economic reality, Domestic politics and international alliance pressures are heavily influencing the debate. This leaves Australia with a complex dilemma. Should public money be used to reclaim a profitable asset solely because it is foreign-owned? The controversy arises not from mismanagement, but from the political sensitivity surrounding ownership. Historically, Beijing has taken a cautious approach to disputes involving Chinese companies abroad, preferring quiet negotiations, lengthy dialogue, and occasionally absorbing financial setbacks to protect long-term diplomatic relationships. That approach is shifting, not out of emotion, but because China's overseas investments now carry strategic weight. Chinese firms are deeply involved in global infrastructure, operating ports, mines, energy systems, telecom networks, and industrial hubs across continents. If governments can cancel agreements citing national interest after projects succeed, the perceived risk for Chinese outbound investment increases sharply. The concern about Darwin Port is less about its size than the precedent it could establish. If a government can legally reverse a lease without consequences, similar actions elsewhere may follow. China's position today is markedly different from 20 years ago. In the early 2000s, it relied heavily on foreign markets, but by the 2020s, its trade network is far more diverse, sourcing iron ore from Africa and Brazil and agricultural goods from Southeast Asia and South America. Australia, by contrast, remains heavily dependent on Chinese demand, which gives Beijing leverage. China does not need overt sanctions to respond. Administrative delays, selective inspections, import restrictions, or WTO arbitration can all exert pressure within legal bounds, creating significant economic impact without open confrontation. Beijing's messaging has been deliberate and measured, emphasizing that contracts sanctioned by governments should not be invalidated simply because domestic politics change. The larger question concerns the reliability of international commercial agreements. Looking forward, Chinese investors are likely to adapt, prioritizing jurisdictions with strong legal protections, embedding arbitration clauses, and planning for political risk. Investments will include clearer safeguards and compensation measures. In unstable markets, investors will seek higher returns to offset uncertainty, while major projects may align more closely with diplomatic channels, ensuring state-backed coordination to protect strategic interests rather than military involvement. China's approach balances caution with a firm reminder that breaking contracts has consequences. Several scenarios are possible. Australia could negotiate a settlement, compensating the leaseholder fairly, keeping relations functional but cooled. It could cancel unilaterally, triggering lengthy legal battles and trade tensions that undermine investor confidence, or it could reconsider domestically, delaying or abandoning the revocation, allowing commercial operations to continue while managing internal political fallout. At its core, this is about more than one infrastructure asset. It raises fundamental questions about contract reliability in a world where geopolitics increasingly shapes economic decisions, testing whether a rules-based framework is applied consistently. It also signals a shift in China's stance as a global investor, now less willing to quietly absorb losses when agreements are overturned, communicating boundaries rather than seeking conflict.